Okay, so last 4 meetings, we learn about accounting process or accounting cycle in a service business. So last 4 weeks or 4 meetings, we talk about accounting cycle in service business. Because we start with service business because service business is quite simple. It's quite it's quite simple to run. The only thing that you can sell to the customer is your skill. So you don't need to buy merchandise inventory. You don't need to manage the inventory. You don't need to have a fancy shop or selling or any other activities that complex. So what you have is your skill and you sell your skill to your customer. But now in this meeting, in this topic or in week 5, we are talking about accounting cycle in a merchandising business. So now we are talking merchandising business or trading business. There are some differences between service business and merchandising business, and I hope you know because it's a common sense, right? I hope you know what are the differences between service business and merchandising business. So let me listen your voice. Let me know how do you describe the difference between service business and merchandising business. If you don't mind, Umaira, please tell me what do you know about the difference between service business and merchandising business.
As far as I know, merchandising business has distributor.
As distributor for what?
Or to get to the customer.
Okay.
To and get the product directly.
Okay, to distribute the merchandise inventory. Okay, good. They have to have distributor. However, they have to build their distribution system. They have to manage their logistic system to distribute the merchandise inventory from the main warehouse to the customer. Yes, I think it's right. In service business, you don't need that kind of system. What you have is your skill and how to sell it to your customer. Or you can teach other people to have the same skill as yours, then you can sell together with these people. Okay, any other comment? Let me listen your answer, Safira.
I think for the service business, it's like the seller doing something to the customer, and for the merchandising business, they sell items to the customer.
Yeah, you're right. In terms of accounting, the basic difference between these two, I think it's not merely about accounting, but also about management. In computing the profit of service business, it's simply deducting the expenses from revenue. So we have revenues minus expenses. Then you got the profit or net income. Let me use accounting term, net income. Simply as this, you can check your last assignment. The income statement. The income statement is quite simple. The revenues is on top, followed by expenses, and then the bottom line is net income. That's all. However, in merchandising business, you have two steps to compute the net income. The first step is to find or to compute what we call as gross profit by deducting costs of goods sold from the total sales revenue. So you get this gross profit. Sales revenues is the total revenues that earned or generated from the sales activity from the customer, and cost of goods sold is actually the cost of the item of the merchandise inventory that you already sell to the customer. Let me give you a very simple example. So for instance, you have a pair of shoes, and suppose you sell these shoes for like 500k rupiah, and then you bought that shoes from the supplier, for instance, about 400k rupiah, and then your gross profit will be 100. So cost of goods sold is the cost of the item that you sell to the customer. Okay, why do we need to calculate gross profit in the first step? Because as a merchandising business, you have to be aware, you have to focus, you have to manage the cost of goods sold as efficient as possible. Then you have to see it, you have to monitor it. Whether you bought these shoes, whether the shoes is too expensive or too cheap, or it's a fair price. How do you know that if you don't calculate the cost of goods sold, if you don't keep the record of cost of goods sold? So the main purpose of this first step is to show how can you maximize your profit. The first step, maximizing profit in merchandising business, is to manage the cost of goods sold as efficient as possible. Cost of goods sold itself, simply it's a purchase price of the good that you sell to the customer. So it includes purchase price of the item. Okay, and it can include as well the freight costs, the transportation costs. For example, the purchase price of the shoes is 400, but to get that shoes, you have to pay a transportation cost or freight costs like 50,000 K. Then the total cost of goods sold is 450, right? So purchase price, freight costs, and any item that necessary to bring the item ready to sell or ready to use. So cost of goods sold is one of the main account in merchandising business, because it represents how efficient your company managing managing the inventory, how efficient your company acquiring or purchasing goods to be sold later from the supplier, whether you have a good supplier, whether you have to change your supplier, whether you can think about your supplier. Please focus on the cost of goods sold, because this represents your spending to have or to get the inventory. Okay, so the first step is to calculate or to count gross profit. Okay, after that, in the second step, this gross profit deducted by the expenses. Let me use this operating expenses. So then you will get this, the net income of the business. Okay, so here the operating expenses represent how efficient your business run, how efficient your business manage, how efficient your activity done. So the cost of goods sold represent how efficient you acquire the item to be sold, and operating expenses represent how efficient you handle the business, how efficient you pay the salary, how efficient you use the asset, how efficient you use the electricity, how efficient you run the business, for in the sense or in the administration process. So these two items, cost of goods sold and operating expenses, is the main, these two are the main target of efficiency process in merchandising business. However, we don't have this complex structure in service business. Okay, so I'm trying to explain this accounting term from your side, from business side, from manager side. So I don't explain this from my side as an accountant. As an accountant, it's just a number. But from your perspective, you have to think this structure from managerial perspective. What can you do with cost of goods sold? What can you do with operating expenses that more important for you as a manager, or at least as a future manager? Okay, so I think this is the main differences between service business and merchandising business from accounting perspective or from managerial perspective. In managerial perspective, then you can take, or you can analyze the structure from management function. For example, how to maximize the sales revenue, because sales, who create the sales revenue, who responsible to the sales revenue. This will be the marketing division or marketing department that have the main responsibility to maximize the sales revenue. And who will be responsible for cost of goods sold? This will be the logistic manager or the supply chain manager, or whatever position that you want to call. And who will be responsible for the operating expenses in managerial sense? It should be the suppose it should be the operating manager, or maybe the administration manager or whatever position that have the responsible to take care the administration process of the business, right? So I think this is the main differences between a service business and merchandising business from accounting and managerial perspective. Again, if you have any question, just raise hand and speak up. Don't be shy. Don't be silent. And because I don't know whether you understand or not. Right. Okay. Next, what else? Now let me show you the business cycle. Business cycle. Business cycle. In service business, because the main asset is your skill. The main asset is the human skill or human capital or intellectual capital. Then there is no complex operation. I think the main operation is you sell your skill, provide the service, get the payment. That's all, right? But in merchandising business, there are some activities to get the revenues. So it's not an instant process. First, you have to purchase your inventory. Okay, purchase the inventory first. And then, of course, you have to manage, right? You have to manage this inventory. You have to keep it in a proper warehouse. You have to handle this inventory. Later, you will learn this in operational management. Okay, so after you purchase the inventory, of course, you have to handle it. You have to manage, and then you have to sell it, right? Sell the inventory. Okay, then you collect the payment, right? Collect the payment, and then, collect the payment, and you get the cash, and you use the cash to purchase the inventory, and the cycle will start again from the beginning. So the cycle sometimes takes a short time, sometimes takes a longer time. In certain business, the cycle can be just like a week or even one day, like small what you call small booth, food booth in your neighborhood. Maybe the cycle will be only one day. First, the seller prepare the food in the morning, then and they open the booth and they stay for like 8 hours, and then in the afternoon they close the booth. That's all. So tomorrow they will repeat the same cycle. But sometimes this cycle can take a longer time. Can take like a week or a month or even years. Depend on the inventory that you sell. For example, this car dealer. The business cycle of car dealer is, I think, take like months or maybe year from purchase, from buying the inventory, which is the car, until collecting the cash. They can take like months. So again, this is another problem of your side, of your managerial side. I don't want to talk this too much, but what I want to show you is there is a business cycle that different from the service business. Okay. Okay, then let us focus on the inventory. Okay, then we focus to the inventory because this is the main topic of today. So let's focus how this inventory treated and how this inventory managed in the merchandising business. So the inventory. Oh, sorry. Okay. So the inventory start from zero, right? Start from zero, or we call this as a beginning inventory. Beginning inventory. It can be zero for a new business or new startup, right? And then, yeah, it can be zero. But if the business has run for some time, then it's not zero, right? And then the business can purchase another or new inventory. Okay, they put all this inventory in the warehouse, and we call this inventory as cost of goods available for sale. They are available for sale. I think it's quite clear in English. So you have beginning inventory, it can be zero or not. And then you purchase another inventory, right? You put this inventory in the warehouse, and we call them as cost of goods available for sale. So these are the inventory that available for sale. Okay. And then you sell some of them. Okay. You sell some of them, and we call this as cost of goods sold. Okay, and then the remaining inventory, called as ending inventory or just inventory, but just to make different from the beginning inventory, I have to put that word ending inventory. So this cycle is special or specific in a merchandising business. Start from the beginning inventory, and then they purchase some of them, and then they sell the inventory, and some of the inventory are still in the warehouse in the end of the period. Okay, so now okay, before I going further, if you have any question, just let me know. So now let's focus. Okay, so let's talk this one by one. The beginning inventory. Is there any complexity related to the beginning inventory? I don't think so, because if it is a startup, then there is no beginning inventory, right? But if it is a running well business, then you have the beginning inventory, and the beginning inventory is actually the ending inventory of the last period, right? So this called ending inventory in this period. In the next period, this ending inventory will be called as beginning inventory, right? So what you have in the end of the year will be called as ending inventory, but what you have in the beginning of the year, although they are the same item, the same number, you call this as a beginning inventory for this year, for this new year, right? So the beginning inventory is from the ending inventory of last year. I hope I don't make this quite complex for you. And then purchase. I think it's also straightforward. It's also clear. You can record how many inventory that you buy from the supplier. You can record the price of the items. You can record how much the price. You can record how many the items, how many unit the items. So everything is quite simple or quite straightforward, or at least quite clear or manageable. Okay, then what happened, or what about the ending inventory? So in some business, how we determine the ending inventory? How do we calculate? How do we compute the ending inventory? In some business, or maybe not some, most business, let me use that term. Most business have to physically count the inventory. Most business have to physically count the inventory to determine or to check the balance of the inventory in the end of the year. Suppose you have shop, you have a mini supermarket or mini market, and then how do you determine the inventory in the end of the year? I think the most possible way is to close your shop, do inventory count, physically count. Okay, so most business do the physical count inventory. So they have to, and I think this is the best way and the most rational way to determine the ending inventory. Most business, I say, right? Not all, but most. Okay. For mini market like Indomart or Alfamart that we have in Indonesia, I think it's quite possible for them to close for like a night, overnight. Overnight. They close the shop in the night, and then they do this overnight physical count. Or like a big supermarket such as Carrefour or Transmart and other big supermarket, they can do the same thing. But how do we do this physical count for a big factory like a oil company, coal company, and so on? So they have their own technology to handle the inventory count. I don't want to spend too much on this issue. It will be your concern in operational management. Now let's turn to the last item, cost of goods sold. How do we know the cost of goods sold? Next meeting or next week, we're gonna talk this item, how to determine the cost of goods sold, because it will be very challenging, very complex. However, to simplify how to compute this cost of goods sold, let me give you 2 examples of business, okay, to compute this cost of goods sold. The first business, is car dealer. Okay, this car dealer has limited number of items, okay, in their shop, in their warehouse. Suppose let take a bigger or biggest car dealer. How many car they can sell? Like 100. They keep 100 car in their warehouse. Quite big, I think. Quite big car dealer. Suppose they have 100 car. They have 100 cars. Okay, with many types. Okay, many types, many brands, and so on. Okay. And because this is 100 cars, of course, the company or car dealers has a very big warehouse. The second business is just a supermarket. Can you count the items? Oh my God, how to imagine? So let's suppose take one item of the inventory. They have instant noodle. So how many instant noodle they have? Or they have Indomie, they have Super Me, they have Mie Sedap, they have many brands with different price, with different flavor. Oh my God. So, and you can imagine if they have to record that inventory. Next, after instant noodle, then you take the shampoo, Body Shop, another food, another stuff in that supermarket. It's quite complex, much complex compared to the car dealer. In this business, in the first business, the purchase is easily recorded. The purchase is easily recorded because you have the evidence from the supplier, right? Before that, then the beginning balance, how many car you have in the beginning of the year, it's also it's quite easy to calculate. Okay, I have 20 cars in the beginning of the years, and then you can calculate the price, right? Or you can calculate the cost of that 20 cars. So the beginning balance is also easily recorded. And what about the cost of goods sold? Cost of goods sold, it's also easily determined. Suppose in a year you sell like 50 cars. I think it's quite easy to make note which car sold and how much the cost of that car is also easily recorded, easily determined. Okay. And then the last is the ending inventory. It's also easy to determine. After selling these 50 cars, what I have in my warehouse is now 50 cars left. And I can calculate and I can determine how much the cost. Okay. I use cost. So please don't mix up with price. Especially for you guys that bahasa, that you speak in bahasa, cost and price it's not the same. Okay, price is the price is what you ask from your customer. Okay, cost is what you spend to get the item and you paid it to the supplier, right? So price is what you offer to the customer. Cost is what you paid to the supplier. They are different, so please don't mix up. So I use cost. Many times I use cost. I never use price. Price is your business. Is the marketing thing. It's not my part. So again, back to this car dealer. Suppose this car dealer has 20 cars in the beginning. I think it's easy to calculate the cost, right? And if the car dealer now purchase another 80, it's also easy to trace or to determine how much the cost of this 80, because you have the receipt, you have the invoice from the supplier. The cost of goods sold is also easily determined, because you can remember how many cars you already sold to the customer during the year and how much the cost of this car. I think it's easily determined. Okay, I sell that Kijang Innova, and that Kijang Innova cost is, for example, 400 million rupiah, and then you sell it for like 450. So you can easily determine, right? And then how much the ending inventory cost is also easily determined for this car dealer, because they have limited number of inventory items and the value of the items is significant, is a big number. However, this supermarket is much complex compared to this car dealer. Beginning inventory. Suppose we make it simple. Beginning inventory is the ending inventory of the last period. Suppose the number is there in the computer, you can find it. Okay, so let's assume we can get the balance or get the number easily. Purchase, it's also easy because you receive the invoice from the supplier. Okay, you can keep it, you can record it, how much price that you have to pay to the supplier to purchase this item. Although you have hundreds types of inventory, it's still manageable because you have the document, you have the receipt, you have the invoice from the supplier. And then for the ending inventory, I think there is no other way to calculate except doing the physical count. Close the shop, close the supermarket, do the physical count. But it's quite challenging to know the cost of goods sold. Suppose one customer, what I have here, okay, one customer buy just one piece instant noodle, Indomie goreng, this fried instant noodle, original instant noodle. So one piece of Indomie. And then you have to think, you have to record how much cost of this one piece of Indomie. You know the price, you sell it for like 3,000 rupiah. It's easy, okay? The price is 3,000. The customer will pay you 3,000, then enough, then finish. But then, how much the cost of this Indomie? Okay, so how to determine? Okay, which Indomie? This is the original one. Okay, then you open your recording, your software to find the cost of this Indomie. I think it's quite challenging to find the cost of goods sold for this business. Or let me give you more simple business, but more complex computation of costs. You know, in Indonesia, we have the fried rice seller. They open their booth in the night. Okay, so this fried rice use several ingredients. Apart from the rice, they use some vegetables. They use some pepper. They use salt. They use some other ingredients. They use garlic. Can you and they sell like a plate of instant of this fried rice. They can sell like 20,000 rupiah. Okay, they can sell it 20,000 rupiah. The price is easily determined. But if you ask the seller how much the fried rice costs, it is not easy to answer. How much the cost of the rice? How much the cost of the pepper use? I just use 1 spoon of pepper. Then how much is it? Oh, they will never know. They will never know. How much the cost of the garlic they use? How much the cost of the vegetable they use? How much the cost of the all the ingredients will be quite challenging to determine. Again, the business is simple, but the cost calculation is not simple. When you fail to calculate the cost, then you fail to calculate the gross profit. Back to my previous explanation. When you fail to calculate the gross profit, then you will fail to manage the business, because you don't know how much the cost that you have to manage. So this cost of goods sold remain complex for the supermarket and another typical or another complex operation or complex processing business. Okay. But then accounting provides solution for these two business. So for the car dealer, because they can keep the inventory record updated anytime, then they have to update. And they can, not just they have to, but they can update the inventory record, every time or anytime. And they can also update cost of goods sold record, because the item is limited. Is manageable. So they can update how much inventory I have now, today, this time, this second. They can mention it because they can manage. They can keep this inventory record updated anytime. Okay, but for the supermarket, for the restaurant, And another typical or the like business, they have to update, they can update the inventory record and the cost of goods sold. Oh my God, cost of goods sold record periodically. So they don't need to update their inventory record every day or every time. They can calculate the inventory every like 3 months or every 6 months. Then they can calculate the cost of goods sold every 6 months. So back to our example of this fried rice booth or fried rice restaurant or fried rice seller, they don't need to calculate the cost of goods sold every day. They can calculate the cost of goods sold like once a week. So in Monday they have 1 kilo of salt, and in the Saturday they have like half kilo of salt. So in 1 week the salt has been used half kilos. So the cost of goods sold, I mean the cost of the fried rice during that week will be include this half kilo of salt, right? So in Monday, another example, in Monday they have like a 10 kilo of 10 kgs of garlic, and in the end of the week the garlic now like 4 kilos. So during the week the seller already used 6 kilo of garlic, so it will be included in cost of goods sold as well, right? And they do the same thing for the rest of the inventory. So they calculate the cost of goods sold, they calculate the inventory periodically, not every day, not every time. So these two systems exist for two different businesses. So if the business can manage the inventory easily, because the inventory is limited, the number of inventory is limited, the cost is quite significant, so they can manage the inventory, or they can record the inventory easily. They have to update the inventory and cost of goods sold record every time or any time. Sorry. But for the business that has very complex inventory, they don't need to update the inventory anytime. They can update the inventory record and cost of goods sold record periodically. Okay, because of these two type of business, then accounting provide two different systems for them. And the system that used by the first business called perpetual system. The word perpetual is actually the word perpetual means updated every time. And for the second business, we call this as periodic system, or sometimes people call this as a physical system, because they calculate the period, the inventory periodically, and they have to calculate physically. They have to count the inventory physically. I hope I can explain this clear for you. If you have any question, so again, don't mind to ask. But this is not the end of the topic. This is just the beginning of the topic. Now, these two systems will assist or will guide how accounting record the transaction for the business. So which business is going, the system will follow. If the business is like this car dealer business, and the system will follow, and the accounting will follow the system. So the accounting depends on the system that the business used. That's why in this meeting we're gonna talk these two systems side by side. Okay, to show you how to run or how to do the accounting for these two businesses. Okay, back to the accounting cycle, or back to the business cycle of merchandising inventory. Now we're gonna focus on the transaction business cycle of merchandising business.
Pak,
Yes, please.
I have a question about the cost of goods sold. Just to clarify, so in a journal, would the cost of goods sold be classified as an expense?
Yes, correct. True.
Oh, okay. Thank you, Pak.
Okay, as I show here, cost of goods sold necessary for calculating the gross profit. So we deduct sales revenue with cost of goods sold. Means we treat this cost of goods sold as an expense. So it's part of it is part of the expense account. Although we use cost, cost term, but it is classified as expense account. Good question. Yes, this is expense. Any other? So cost of goods sold is an expense related to the inventory that you sell. Right. So if we go back to this slide, so cost of goods sold is actually an expense that specifically related to the item that you sell. But operating expenses is any expenses that related to the business who sell the item. Okay, so they are from different units, or they are from different levels. Again, cost of goods sold is the expense that related to the item sold. Related to the item sold. Operating expense is expenses that related to the company, to the business, to the firm that sell the item, that sell those items, that sell the inventory. Okay, so if you can imagine, we have supermarket, they have shop, right? And they have office. Okay. So any expenses related to the business is actually from the office. But inside this shop, they have inventory. Again, the expenses related to one item is cost of goods sold. Okay. Okay, good question. So let me go on. Business cycle of merchandising start from purchase, right? Purchase. If the company purchase an item, then the company receive the inventory, right, from the supplier. Then we record as inventory will increase, so we debit the inventory. And usually we purchase the inventory on account, so we record account payable. It can be cash, yes, if there is a if it is a cash basis transaction, then you have to record cash. However, usually merchandising business do their transaction on account, usually for the purchase, but not always. So you can debit, you can credit the account payable. We debit inventory because we receive inventory from the supplier. We credit account payable because we now have a new payable to the supplier, new liability to the supplier. Okay. However, sometime the buyer needs to pay the freight. Okay, the freight. Transportation costs. Okay, related to the freight, let me tell you how the business treat this freight. We have two different practices in treating the freight in the business. First, we call as freight on board, freight on board, or FOB, shipping point, freight on board. In FOB shipping point, I think this is the common practice and internationally practiced. In FOB shipping point, the goods belong to the buyer once they are shipped. So once the goods are shipped on board, then the goods belong to the buyer. All the risk related to this freight, related to this transportation process, related to this transportation process, all the risk will be borne by the buyer. Okay, like what you do in online shopping. In online shopping, mostly we use this FOB shipping point. We pay the freight costs. So all the risk with this item will be borne by us as the buyer. That's why sometimes the platform or the apps ask you to purchase another insurance to protect your item. Okay, and the second freight system called FOB, freight on board, destination point. Destination point. In this system, goods belong to the buyer once they are arrived in the destination. So the seller will pay the freight. So in the first system, the buyer pays the freight because the goods belong to the buyer once they are shipped. But in destination point, goods belong to the buyer once they arrive in the destination. So who paid the freight? It is the seller. The seller pays the freight. Okay. So suppose in this purchase we use FOB shipping point, and then the buyer should pay a freight cost to purchase this inventory. So how the recording or how the accounting record the buyer pays freight costs? Of course, on credit will be the cash, but what will be on debit? It is the inventory. Why the inventory is on debit? As I said, as I gave you example previously, if the shoes price, or if the shoes cost purchase price is 400 and the freight cost is 50, then the cost of the shoes is 450, right? It's not 400 only, but we will include the freight cost into the inventory cost. So here we record freight costs as part of the inventory balance or inventory costs. Okay. Next, what if the buyer return some of the goods because it doesn't fit with the spec, with the specification, or it could be some defect items. So the buyer return some of the goods. Then in accounting sense or in accounting record, of course, we have to credit inventories because some of the inventory are now returned to the supplier. Then what will be on debit? Of course, our liability, accounts payable, our liability to the supplier now decreasing because we return some of inventory. So we debit accounts payable. Right? We debit accounts payable because the liability now is lower. We credit inventories because some of the inventory now excluded, now returned to the supplier. Okay. Next, we pay the debt. Okay. We pay the debt or the account payable. So usually, again, let me explain some common practice in business. Usually, we follow, when we pay the debt, we follow credit term. We follow the credit term. So when we purchase the inventory on account, then the the supplier can apply a certain credit term. So we have to follow the credit term in paying our debt. So the credit term can be expressed as 2 per 10 and per 30, like this. I think it's common business practice. Or it can be 2 per 10 EOM. Anyone can explain what does this term means? The first 2 per 10 and per 30? No one knows? Or no one wants to answer? What does it mean?
Is it 2% discount to pay in 10 days?
Mm-hmm. Yes, then? Yes, correct. The first term is correct. Then, and per 30, what does it mean?
Or the net amount due within the 30 days?
Okay. So, 2% discount, 2% discount given if the payment is within 10 days after, or 10 days after the invoice date. Okay. So 2% discount given if the payment is within 10 days after the invoice date. And then N per 30 means the due date is 30 days after invoice date. Okay. So what does EOM means? Anyone knows?
End of the month.
Yes. So Mario, can you interpret how what does this term mean?
For the EOM, right? The EOM.
All of this term, how to interpret, how to explain this term. 2 per 10 EOM.
2 per 10 EOM. Sorry. 2 per 10 EOM. It's like due date is like
Start,
date is unknown or something. Hello. Sorry.
start from 2 per 10. How do you interpret that 2 per 10?
2 per 10. It's like given the date. 2 per 10 is like the date. 2.2005 cent.
2% discount.
2% discount. Given this payment, this term payment is
Within
10 days.
days after
10 days.
After the invoice date.
Invoice date for around 10 days.
2% discount given if the payment is within 10 days after the invoice date.
The invoice
It
date
will be
will be
the due date will be end of month.
end of month.
Okay. So there are some other credit terms. You can find it on in your book. There are many credit terms, but This is how we read the credit terms. Again, this is not accounting part. This is managerial part, because this is a common practice in business. So when the company or when the buyer want to pay the debt, they have to check the credit terms. Okay, so if the buyer want to have or want to get discount, then they have to pay within 10 days after the invoice date. But if they miss the discount date, then they have to pay like within 30 days or before 30 days or in the end of month, right? So back to our transaction then. So when the buyer pays the account payable within discount period, what will be happen, or what will be recorded? So we debit accounts payable. Oh my God. And then of course we have to credit cash. However, the cash will be less than the account payable because we pay within discount period. We receive some discount. Then we pay less. We pay cash. We spend cash less than the account payable balance, right? So in case of 2 per 10 and per 30, then the cash is only 98% and the accounts payable is 100%, right? So it's not balanced. How to balance this? Then we deduct the value or the cost of inventory. We deduct inventory because we pay less costs to get this inventory. So we credit inventory. It doesn't mean that some of the inventory now gone, but we reduce the cost of inventory due to this discount. Okay, so what if the buyer pays the account payable outside discount period? Then all the account payable is debited, and then we also spend 100% cash to close or to pay or to offset the accounts payable. Question? No? Okay. Purchase. I think we're done with the purchase. Now we turn to the sales cycle. So after we purchase the inventory, now the inventory is available on our warehouse to be sold. Then we do the next transaction, which is sales transaction. Sales transaction. So first, we sell the inventory on account or on cash. It's up to you. It's up to depend on the business, can be sold on cash or on account. But whatever term they use, we always record an asset. We receive some asset from the customer. If we sell it on account, we gonna record accounts receivable, and we credit sales revenue, right? We debit accounts receivable because now we have a new accounts receivable, which is an asset. So we debit an asset called accounts receivable from the sales transaction, and also we record the sales revenue. Okay. What about the freight? Now, what about the freight? If the freight is FOB shipping point, if it is FOB shipping point, who paid the freight costs? Depot, if you can hear me. In FOB shipping point, who paid the cost?
The buyer, Pak.
Buyer. Okay, good. So the seller will not record this cost, right? But if it is FOB destination point, so the cost will be paid by the seller. So in this case, the seller will spend some cash, so the cash will be on credit. And what will be on debit? It is selling expense. Selling expense. It's not all? No. As you can, as I told you previously, when we follow the perpetual inventory system, we have to update the inventory record anytime we conduct a transaction. In purchase transaction, we always update the inventory account, right? When we purchase, we debit inventory account. When we pay freight, we also debit the inventory account. When we return the inventory to the supplier, we credit the inventory account, and so on. So we do the same thing, which is updating the inventory account when we sell the inventory. Okay, so in addition to the first transaction, we have to record cost of goods sold on debit. Again, cost of goods sold is actually expense account. It is an expense account. And we credit the inventory that we send to the customer. We credit the inventory because some of inventory now sent to the customer. We credit cost of goods sold or expense account because now we already consume the benefit of the inventory by selling it. Okay. Question? Okay, if you didn't get now, it's fine. Later you can play the recording. So once I finish, then I can download the recording for you. So in sales transaction, we have two journal entries. First, to record the revenues, and the second to record the inventory shipment or inventory reduction or inventory deduction. We increase the sales revenue and accounts receivable, the first step. Second, we record the deduction of inventory because we now sell that item. And then of course we have to record the expense or cost of goods sold account. Why it is an expense? Because we consume the benefit of inventory by selling the inventory. That's the philosophy why cost of goods sold is part of the expense account, because we already consume the benefit of the inventory. Next, what next? Suppose the customer return the inventory. Okay, if the customer return the inventory, then we receive the inventory. So first, receive inventory by debiting the inventory and crediting the cost of goods sold. We cancel the cost of goods sold that previously recorded. And second, we write off the accounts receivable, okay, by crediting accounts receivable and debiting an account called sales return. Okay, this sales return is actually the contra account of sales. Contra account of sales. So sales return will deduct the total sales. Why do we record this return in a specific account, sales return? Again, from the managerial side or from the managerial perspective, it's quite important for you to trace whether or to determine whether your inventory is in good quality or not by evaluating the sales return account. I think it is meaningless if the company has very high sales revenue but followed by high sales return, right? So it is important to keep sales return in a separate account for you to manage or to evaluate the quality of the service or the quality of the inventory, or at least the satisfaction of the customer. If they return the inventory, mean they don't satisfy with the inventory from your shop. Okay. No question. Everything is fine. Then next is the payment or collection, receivable collection. Receivable collection. Again, we can apply in two scenarios. First, the receivable collected within discount period. So you give the customer discount. So in this sense, or in this scenario, we receive some cash, right? And the cash will be less than the accounts receivable because you give them a discount. Suppose it can be 98%, but the accounts receivable close is 100% on credit. So what will be on debit? It is sales return. Sales discount. Sales discount. So suppose 2%. Again, why do we need to record sales discount in a separate account? And this actually, again, the contra account of sales. So the total sales will be deducted by the sales discount. Again, it is to monitor how good your marketing division. So for example, if you have high sales revenue, but in the same time you have high sales discount, so actually your sales revenue is not that high, right? Because you offer too much sales discount to the customer. So in managerial sense, it is very important to record sales discount as a separate account. Okay, so what if the customer pay their debt, which is our receivable outside discount period, and then we simply debit the cash and credit the accounts receivable. Sorry, let me go on that side. So let's recap from the beginning. The business cycle of merchandising start from purchase. So we purchase the inventory. Okay, purchase the inventory. If the buyer has to pay the freight, we can record the freight cost as an addition cost by adding a freight cost to the inventory cost. And then when the buyer return some of the goods, the buyer will deduct the accounts payable and the inventory as well, right? When the buyer pay the debt or pay the accounts payable within the discount period, they will spend some cash that less or lower than the accounts payable. So the difference will reduce the inventory costs. Okay, and then now the company can sell the inventory to the customer. When the company sell it, the company record addition on sales revenue and accounts receivable, and in the same time they record deduction on inventory, right? And then when the customer return the inventory, they receive the inventory back, and they have to record sales return. Okay, and then the last, when the company or when the business or the company collect the receivable from the customer, the company receive the cash and then write off the receivable. Okay, this transaction is actually for the first system, which is perpetual inventory system, like the car dealer as the example. In this system, the inventory is updated every time or any time there is transaction, either purchase or sales. Okay, so what if the system or the company is a supermarket? So we have to apply the periodic inventory system or physical inventory system. Actually, it is quite simple. We don't touch the inventory account. So when it is purchased, I mean, when the firm purchased the inventory, we record an account called purchase instead of inventory. So we change to purchase account. We don't use inventory. We use purchase account for periodic system. So let me write here. Blue is for periodic system. Again, if the buyer pays the freight cost, they will not record as inventory addition. They will record as freight or freight in, defined freight in, which is freight in actually the same account as purchase. I mean, they will I mean, we gonna add them together. So in periodic system, we don't use inventory. When we pay the freight cost, we use freight in account. Freight in is actually the same account as purchase, but we have to name it differently because we need to trace, we need to manage how efficient you choose your transportation mode. We have to manage, we have to evaluate how efficient the freight costs. That's why we record as a different account, which is freight in, but actually it is the same as purchase. We name it differently for management purposes. Okay. Okay, what if the buyer return some of the goods? Again, we don't use inventories. Instead, we use what we call as purchase return. We just change the name. Again, blue is for periodic system. Okay, what is periodic system? An inventory system used by a business that cannot update the inventory anytime. Why they cannot update the inventory anytime? Because they have a very complex inventory transaction or inventory system in their business. Okay. So what if they the buyer get some discount from the supplier? In perpetual inventory system, we deduct the inventory cost, but in periodic system, we record as purchase discount. Okay, again, it is for periodic system. We change the name. Next, in sales transaction, periodic system, we still record accounts receivable and sales revenue, But for the second journal entry, we don't have this in no journal in periodic system. Because we cannot update the inventory record anytime. We're gonna update it later in the end of the period. What else? Okay, what if customer return the inventory? In perpetual system, we receive the inventory and cancel the cost of goods sold that previously recorded. In periodic system, we don't use this journal. So no journal in periodic system. But the second journal is still relevant. Okay. And lastly, for the payment method, collection, because there is no journal related to the inventory, then they are the same. There's nothing to do with inventory. Okay. Lastly, guys, after doing all the transaction for the years, then the company will prepare the financial statement. For the statement of financial, my God, my handwriting getting worse. Financial position and a statement of changes in equity, I think nothing special, with merchandising business compared to the merchandising business, compare to the service business. Okay, so they are mostly the same, except a very, very small item under the asset. We're gonna have inventory on the statement of financial position, just one item or one line. So nothing, it's not a big deal, right? But for the statement, income statement, then the problem is here. Income statement. First, we have to provide the sales revenue. But the sales revenue is quite complex. First, we're gonna take the sales revenue, deduct by sales return, right? Deduct by sales discount to get net sales. My God. See? Or net sales revenue. First. Second, we have to deduct the net sales revenue with cost of goods sold, right? Then we get gross profit. And then we put all the expenses here and to get the net income. Please refer to the book and to the PowerPoint that I provide you on Aula to know this in detail. In perpetual inventory system, oh, sorry, not this one. The cost of goods sold. The cost of goods sold in a perpetual inventory system is available anytime, right? Because they keep this cost of goods sold updated anytime if there is a transaction. But for periodic system, they have to calculate it. Periodic system, they have to calculate. How to calculate? Okay, see the next slide. How to calculate? First, as I show you in the beginning of my presentation, the business cycle of merchandising operation start from beginning inventory, right? And they purchase some inventory from the supplier, and then they sell some of the inventory, and then some of the inventory remain in the warehouse, and they call as ending inventory, right? And mathematically, they follow a very simple system. For example, if the company has 10 beginning inventory, and then they purchase another 20 inventory, if 12 units left in warehouse in the end of the period, then 18 has been sold, right? They follow the simple system. We call this cell as cost of goods sold, right? So how to determine cost of goods sold? It is beginning inventory plus purchase minus the ending inventory. So back to our question from previous slide, how to calculate cost of goods sold, how to compute cost of goods sold. Start from beginning inventory, okay, and then purchase. But we have to consider some other details in this purchase. First, the purchase cost itself, deducted by or added by freight in, okay, deducted by purchase return, deducted by purchase discount. My God, to get net purchase. The net purchase will be added to the beginning inventory, and we call this as cost of goods available for sale. The inventory that available for sale. And then we deduct this cost of goods available for sale with the ending inventory balance to get cost of goods sold. How to determine the ending inventory balance? By doing physical count. So I will stop at this point. If you have any question, any issues, please don't mind to ask me question. Nothing? Okay. Then after this, you still have time to study. You still have time to recap by watching the videos that available, the video that is available on Aula. I think that is quite simple, quite short and nice video. So don't mind to watch the video. And then later I will also post the recording of this video to you on my YouTube channel and also on Aula. Nothing to be discussed, guys? Everything is fine? Okay. For the practice exercise, you can take, you can open your book, you can see on your book. So there are so many practice exercise. But what I explained to you is actually the principal thing, the backbone of the topic. So later you, for the details, please study your book, study the learning materials. And if you don't have any more issue or more question, then I will stop. I will conclude this class. So see you next week, inshallah. Stay healthy, stay safe with your family. Happy holiday or happy weekend. And see you. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi